There are a lot of things that you can do to improve a real estate investment analysis, but if you really want to take things to the next level, there are a few extras that are definitely worth considering adding to your real estate financial models. These things can help you proactively address investor concerns, add an additional layer of assurance when underwriting your own deals, or just impress your boss if you're working in the industry in an analytical role. So in this video, we'll cover 4 of the most helpful and advanced analysis concepts that I've picked up from my 10 plus years working in the industry alongside some of the biggest institutions in commercial real estate and how each of these can be used within a real estate financial model. So the first type of analysis that I want to cover is going to be applicable to any investor that's focused most on maximizing the IRR first and foremost, and this is a hold-sell analysis. A hold-sell analysis allows an investor to look at a variety of different potential sale dates all at the same time, and then also calculate returns for each of those scenarios. Now, you can run a hold-sell analysis at any point during a hold period, but I find that this can often be most helpful when you're first acquiring a deal and trying to plan out your initial investment strategy, especially for private equity firms or general partners that are compensated based on exceeding certain hurdle rates that are directly tied to the IRR. Figuring out the optimal sale year up front can help you decide how many years you plan to hold an asset and the timing of projected renovations, both of which need to be planned for and communicated to investors. And while it might seem like this is typically a really clear answer, with shorter hold periods generally maximizing the IRR due to this being a time value of money metric, this isn't always the case, and this can vary based on strategy and what an investor plans to do and when they plan to do it. For example, on a value add or opportunistic deal where you're planning to increase NOI quickly through a projected renovation or releasing play, you'll usually see the IRR increase as you continue to hold the deal throughout that repositioning period, but then this is usually going to peak shortly after stabilization. And for core and core plus deals that might have more steady projected cash flows over time, this analysis might tell you that holding the property as long as you can is actually the best thing that you can do to maximize returns. If you're a GP being compensated based on the IRR directly, or if you're an individual investor that's focused most on the IRR, this can be a great way to plan out your investment strategy and can be a really helpful addition to your models when analyzing deals. Now, this next type of analysis can be a great way to analyze the risk associated with a potential investment, and this is referred to as partitioning the IRR. Partitioning an IRR involves calculating the percentage of the IRR coming from operations versus the percentage of the IRR coming from sale proceeds. And one of the biggest risks when investing in commercial real estate is relying too heavily on a speculative sale price in order to generate returns. And in most cases, investors can reduce this risk by minimizing the portion of the IRR that's going to be dependent on hitting a projected valuation at sale and relying more heavily on cash flow from operations that have most likely already been proven out at the property. And the way this is typically done is by first separating out the projected cash flows on the deal between cash flow from ordinary operations and cash flow from net sale proceeds, and then taking the present value of each of these cash flows discounted back at the project's IRR. And once we have our discounted cash flows in total, we can then divide the sum of our discounted cash flows from operations by that total amount to find the percentage of the IRR coming from operations directly, and then we can also do the same thing with the sum of our discounted cash flows from sale proceeds to find the remaining percentage coming from the sale. And if you're a GP trying to pitch a deal to investors, this can be a great way to quantify how much or how little speculation around an ultimate sale price is driving your projected returns, which can help you either adjust your strategy to help reduce that exposure or just provide some additional assurance to investors when these percentages are weighted more evenly. Now, obviously, different business plans will call for different strategies, and deals like ground-up development projects or land banks will inherently generate much more of their IRR values from sale proceeds, but in cases where you're buying real estate that's already operational, this type of analysis can provide a really helpful perspective. Now, the next type of analysis I want to cover here can be a really useful tool to help dial in your sale value projections, and this is a next buyer analysis. In a typical real estate financial model, sale value projections are made by taking the next buyer's first year of projected net operating income, or NOI, and just applying an assumed exit cap rate to that value, which makes the sale value of a property exclusively dependent on the first year of operations. But a next buyer analysis allows you to take this a step further by not only factoring in the first year of the next buyer's operations, but their entire projected hold period, and then calculating their projected internal rate of return based on that sale price. This can help provide a lot more clarity around whether or not your exit cap rate assumptions are realistic based on what that next buyer's returns might be at that valuation. It can be really beneficial in scenarios where the NOI of the property is projected to change significantly after the next buyer's first year of ownership. For example, if you're selling a property with a major tenant that's currently paying significantly below market rents with a lease that's expiring just 2 years after sale, this wouldn't be picked up in an exit cap rate valuation, but this would be incorporated into a next buyer analysis. This can also be really helpful in cases where things like affordable rent restrictions are scheduled to be lifted in the future, a significant increase in assessed property value is expected in the future, or any other scenario where the NOI of the property is expected to be significantly higher or significantly lower than in the first year of that next buyer's ownership period. And even though the exit cap rate approach does tend to be the industry standard in commercial real estate across the board, and this is going to be sufficient in the vast majority of cases, a next buyer analysis can be a great way to continue to dial in your exit cap rate assumptions and provides an additional layer of assurance for investors, especially on deals with major fluctuations in projected cash flows. Now, the last type of analysis that's worth mentioning here is another way to analyze risk, and this is a best case, base case, weak case analysis. Many investors use data tables in Excel to create sensitivity analyses within their models to calculate the impacts of changes to assumptions on returns, but these can often slow down an Excel model pretty significantly, especially if you have multiple metrics that you want to sensitize. But a best case, base case, weak case analysis allows you to add any relevant assumptions you want to control all within one table across 3 different potential scenarios, and allows you to toggle back and forth between these in real time using a simple drop-down list that won't slow down your models. This allows you to see the impacts of changes to multiple different assumptions that you think would realistically be correlated in upside, base case, and downside scenarios. And again, this can be really helpful to show investors both the results of a worst case scenario that you could see materializing, but also an upside scenario if things end up going better than planned. Now, again, a sensitivity analysis can be a really helpful tool to accomplish a similar result, but if you're working in a huge clunky model that tends to freeze a lot or already takes a while to recalculate, this can be another helpful way to analyze different scenarios in a much more efficient way. So I hope this is helpful if you're looking for ways to improve your real estate investment analysis, and if you want to learn more about how to build each of these analyses step by step in Excel, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on real estate financial modeling and analysis, make sure to hit the like button and let me know in the comments any other analysis techniques that you use when analyzing deals that aren't usually incorporated into a standard pro forma. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.